Hello everyone, my name is Reese, and in this video I will be going over my personal thought process and steps that I take when I was building my 401k portfolio and the reasoning why I did what I did. And the point of this video is kind of just to show the different kind of tools and techniques you can use to help find something that suits your needs. And granted, all 401k providers will be different. You know, the what specific funds and access to funds that I have with my personal employer may be different from another company's. It's almost certain going to be different. However, typically, even if the tickers are different, usually these 401k options will provide similar asset classes, regardless of if it's a Vanguard fund, Fidelity, Charles Schwab, whatever it is. Typically, these funds are going to have similar overlap with each other. And so, to start off, my retirement account is being managed through Empower Retirement, and this, some companies will be using Fidelity or whatever it is, but to start off, whenever you are making a 401k portfolio, it's good to know what your time horizon is. So, what I mean by that is typically if you're in your 20s or 30s, you can afford to be a little more aggressive or stock heavy in your portfolio. And as you're getting closer to retirement age, or once you are at retirement age, instead of looking at growing your capital, you want to start looking at ways to preserve it and start getting either some sort of income from it, whether you start looking into more of a bond portfolio or dividend based portfolio. And what's nice about bonds or dividends is that you can, if you get your portfolio to a point where the interest or dividend payments are enough to support your income by itself, that is a great place to be at, because then you don't have to worry about selling your own shares to support your lifestyle. On the other hand, if you are more stock heavy or growth stock oriented, you will have to be selling those shares regardless of if they're at a peak or a downturn to support your lifestyle, because typically, especially growth heavy stocks, are usually going to pay out little to no dividends. So that's an important thing to keep in mind is I'm not going to get into what percentage of bonds or stocks you should use depending on your age. It's just a kind of a rule of thumb is the more time you have in your time horizon, specifically if you have 20 years or longer, the S&P 500 or stocks is kind of a great place to be in, because long-term equity has proven to be the best long-term investment. And then as you're getting closer to retirement, you don't want your portfolio to be as volatile. You want to be more focused on stability and preserving that wealth. And I'm in my 20s, and so I have a long investing time horizon in my 401k. I can't even pull out my money until I'm 60 unless I'm willing to pay a fee, and I don't want to do that. So with that being in mind, my portfolio that I've created for myself is stock heavy. It is 100% going into stocks and equities. And I think that's perfectly fine, especially if you have a long time horizon and you're willing to hold it, because I'm selling these shares, especially if I'm like in the downturn right now. You want to view these, especially when you're investing into a retirement account. Downturns are a opportunity to invest more in at a lower price. You're able to get more shares at a discount, and I think that's a good mindset to have. But going into more of the portfolio oriented things now. So typically, when you have a 401k, you're going to be given a list of stocks or funds that you can choose from. And sometimes, especially if it's a public company, you may be able to choose your investing in your own company stock. But usually, you're going to get provided some sort of target date funds, which are these target date funds are meant to be a set it and forget it kind of thing, where based on your targeted retirement age, so let's say if you were born in 2000, you were going to retire at 60, you choose the 2061 as a rule of thumb. And these, as you can see here, so on my Empower website, the blue color represents equities and green represents bonds. And typically these target date funds are going to be more stock heavy the longer time horizon you have, and then more bond heavy the closer you are to retirement. And so these portfolios are meant to have built-in diversification. They're going to invest in international stocks, domestic stocks, foreign bonds, domestic bonds. So they're going to take on more bonds as you go closer to retirement account. And then beyond another popular asset that's typically included in 401ks is some sort of conservative based investment strategy, and then like a moderate conservative, balanced, growth, and aggressive. Now, keep in mind though that just because these funds have a certain name does not mean that they are always going to be the same. An aggressive fund through my broker might be extremely different from another brokerage's definition of aggressive, and the core holdings may be completely different. In fact, I'm personally really not a fan of these funds that are provided for the conservative, balanced, and growth, because you even just looking at these returns, a 10-year return of what they're considering aggressive and growth, a 10-year average return of 4% and 3.59%. That's honestly pretty sad for an equity heavy fund. You could have invested in an S&P 500 fund and just destroyed these what they're considering aggressive and growth. So it's really good to do your homework and actually look what's in these funds that you have the option to buy, rather than just saying the name like, oh, I'm an aggressive investor, I have time on my side, I'm going to invest in the aggressive fund. Because not only is this getting poor returns, oh, I lost it. The aggressive fund and the growth funds are getting poor returns. They have a very high expense ratio. And when you're looking into a long-term time horizon, you really don't want a high expense ratio that's just eating into your returns every year. So you think about, it's like, oh, let's use 1% as an example. So you have a 1% annual fee. Thinking short-term, 1% fee is not horrible. All right, now what if you're getting 1% from your portfolio taken every year for 40 years? And remember, your portfolio is going to be compounding over time, so that 1% is going to be taking a larger and larger chunk every year, and suddenly that 1% is hurting over the lifespan of your portfolio. If you were to have a 1% expense ratio, that can take thousands of dollars out of your total return. So it's good to really do your homework, go through what is in the portfolio rather than what it just says it is, and then taking into account the expense ratio, because ideally the lower expense ratio the better. And that's what I personally really am a fan of. Big company funds such as Vanguard, which Vanguard is known to have extremely low expense ratios, and I will be getting into that shortly. So now we talked about 401ks are typically going to have target date funds and then some sort of balanced or growth, whatever they want to call it, some sort of asset fund. And then typically they will start including some exposure to potentially some sort of international market fund. So this is like a global equity income. So it's meant to be a dividend paying global income fund, some sort of diversification fund. And then sometimes when you just read the name alone, you really don't know what you're getting into. And so it helps to make sure you know the tools that you have. So usually they'll have some sort of prospectus lineup of, you can see the investment name for each fund that's provided. You may have more or less depending on your specific provider. And then you'll see the asset class, if it's some sort of international, small cap, mid cap, large cap, or bond fund. And then you can look into an overview of the investment. Usually they will attach some sort of PDF or thing that you can download, to where you get a link to what you're buying and what the ticker view is. So let's use this balanced fund, for example. We can open up the PDF. This page is not available. Nice. All right, that's great. I can't even see, but sometimes let's see, this is a T. Rowe Price growth fund, for example, and usually you'll see what the expense ratio is, what kind of fund it is, some historical performance, and it's going to look different for every individual fund. So like look at Vanguard's, this is their filing report. So it's good to read, if especially when you're thinking about your retirement account, you have a long time horizon. It's good to know what you're actually getting into. And what's nice about this specific page is it has access to all the ticker symbols. And what's great about when you have these ticker symbols, you can use tools such as Morningstar, for example, and kind of see an overview of more info about what the expense ratio is. You can go down to portfolio and see, all right, so this S&P 500 fund is going to be mainly large cap, some growth. It's going to show you financial ratios if you are someone who enjoys looking into that. It'll tell you the breakdown of how much of the portfolio is invested into what, and also the top holdings. So for this S&P 500, obviously it's going to be top companies. It's going to be Apple, Microsoft, Amazon, Google, Tesla, Berkshire Hathaway, companies like that with big fund names. And so using Morningstar.com, which I'll provide a link in the description, is a good way to use the ticker that you find and search it into here, and you can kind of get more insight about what it is. Another great tool is I personally have a TD Ameritrade account for my personal brokerage and my personal IRA. And what's great about TD Ameritrade is it gives you access to really dig into the different portfolios, what's in them, what they track, how they've returned, and historically, what their fees look like. It's a pretty great tool to educate yourself. You do need an account with TD Ameritrade in order to use these tools. So if you don't have TD Ameritrade, another thing you can use is something called Yahoo Finance, where you can just pull up the ticker there, and it can give you pretty good information as well. It maybe not be as in-depth information-wise as TD Ameritrade, but it is still a pretty good tool. It's something easy to pull up and graph. Like, all right, so this is the returns it's been averaging, and so on. You can also use Seeking. There's literally hundreds of resources you can use, but this is kind of the steps that I use. And then backtest portfolio visualizer. It's good because you can backtest different tickers to see how they did against each other. Keep in mind though, you really don't want to base your portfolio solely on historical returns, because it's not guaranteeing that those funds will do well in the future depending on their strategy. And then, all right, so going back to the classes, so we talked about the international funds. And then typically you will get some exposure to small cap, mid cap, some large cap, and bonds. So small caps, for those who don't know, I pulled this up because I figured it'd be handy. So large cap companies are going to be companies with market cap values worth 10 billion or more. So think about your larger companies like ExxonMobil, Apple, Google, these big name companies that you know day to day, Walmart, Home Depot, Target, Verizon. These are common name companies that are going to be well known. And then going into mid cap, this is going to be $2 billion to $10 billion range. And really, you're going to start getting into companies that are maybe a little bit more smaller, or they're going to be smaller, maybe not as well known, but they can have good opportunities for investments potentially if they're on the rise. So that's nice about TD Ameritrade is you can pull up these funds and really get an idea. Same thing with Morningstar, is do a dig through it and see what's in these funds. And then small cap is going to be $300 million to $2 billion worth of market cap. And so small caps are going to be smaller companies. Usually they're a little more considered aggressive to invest in them because they might swing a little bit more. They have larger upside potential, but they also have a higher risk of potentially going bankrupt because these are smaller companies. They may not be as well established, but there are still really good small cap companies out there who have strong financials. They just might not have a large market cap. So a little brief overview of what the differences there are. Okay, and so now that we have our basic asset classes that most 401k providers will provide you, granted you may have shorter or more options, it's just those are primarily what I'm going to see in different bases of most 401ks that I've looked at so far have kind of had similar style and themed. And with that being said, your funds will probably be different even if they are the same class. So like my international stocks may be different from your options and so forth. But going into this a little more, So starting off with these target date funds, I know I talked about them. I'm personally not really a fan of these target date funds, especially when we are looking into these returns. These target date funds are performing, especially when I have such a long time horizon. I really want to invest stock heavy, so I don't want as many bonds right now. But these expense ratios are high, poor returns, and they are. So my problem with this, especially as of right now, the bond market is very dependent on interest rates, meaning when interest rates are suddenly aggressively raised, the bond markets will lose value considerably. And that's what we're seeing right now is as these interest rates are raised to fight inflation, older bonds, especially bond funds, they're losing value quickly because the older bonds are trying to keep up with newer bonds. And if you don't know about bonds, is the higher the yield, as the yield goes up on a bond, the price will go down to compensate. And so if the yield goes up 30%, the bond will lose 30% of its value. And it kind of cancels out, but not if you're holding the bond, which sucks. And so that's why these funds are losing a lot of value and they're really not getting a lot of return. So the thing about S&P 500 historically has returned an average between 9.5 and 10.5% over the past, I believe, like 75 years or so. It's long-term. S&P 500 is a great asset to compare your investments to, because if you have a long time horizon, the S&P 500 over time has historically always recovered through any downturn or recession. Because what's nice is that the S&P 500 will kind of companies can move in and out as they become more or less relevant to the industry. So I'm personally not a fan of these target date funds. They're not all target date funds will be equal. Some providers may have better management of them, but I'm personally not a fan of my options. And then going into these portfolios that are considered, let's say, growth, for example. So here we have the breakdown of what this growth fund is so this growth fund is 53% US stock, 26% non-US stock. It's got bonds, so it's targeted more towards a large blend overall. And you can figure out what the bond ratings are and you can dig into it. So, like, you can usually, depending on, obviously your specific funds will be different, but you should have some sort of similar basis for you to really dive into it and really inform yourself of what you are investing in. And then this is a sheet provided by my brokerage for my 401k, where it's a breakdown of every single asset, the ticker, the expense ratio, the date it was started, and then like the year-to-date returns, 10-year returns, quarterly. It gives you a full breakdown for if you really want to see the numbers and how they compare against each other. Okay. Now we're going to keep working down our list. So these funds, especially these growth and aggressive funds, they are not beating the S&P 500. So if you're investing in growth and aggressive and you're not even beating the overall stock market, either A, it's a time period where growth is not in favor, so you might be better suited in a value fund, which is not even really listed as an option for these particular investments. But also, it's a poor growth fund. It might just be, because not all growth funds are going to be equal. They can have the name growth on it, but they might have different components that are causing some to perform better than others. And specifically, when I'm looking at like a balanced fund and I'm getting an average 5-year return of 3%, my high yield savings account, my Capital One, is 3% right now. So why am I risking losing 15% in 1 year if I'm only getting 3%? The risk to reward ratio is not there. So that's my reasoning for why I'm not really a fan of these as well. Granted, if I had better options, or if Vanguard was doing it and they were giving me a lower expense ratio and better returns, maybe I'd consider it. So always do your homework, and a lot of the times your default provider or allocation will be to a target date fund or balanced fund. So it's really good and this is really put on my radar. I was talking to a coworker this morning where he's been with the company for a couple of years. He's been investing in it regularly, taking advantage of the company matching. and he's investing in this balanced fund, and we were looking into it, and since he started investing a few years ago, his cumulative return was actually negative. And if he had been investing in something like an S&P 500 or total market fund, he would have been in the green. And so it's really, I think it's always good to just do your homework and not just do what's recommended to you by your broker or your company, because maybe it's just being a blanket statement that may not apply to your specific needs and goals. So working our way down now. So we've looked at the target date funds, and we looked at these targeted, risk level type investments, and it looks like they're really not something I'm interested in. So now we're going into international funds. So international funds are iffy. So when we're talking about international stocks, it's non-US based companies. And there are a lot of non-US based companies that are listed on the US stock exchange, and those will be excluded. So just because think about like ExxonMobil, for example. They are a global company who operate internationally, but ExxonMobil is not going to be considered in a international fund because ExxonMobil is US based. And so it's things to keep in mind. Not all international funds are created equally. There's going to be developing markets, developed markets, and it's just kind of, you can invest in different stages. So it's good to know what you're actually investing in. There's going to be international dividend funds. And the main idea of including these international funds is usually you're not going to beat the US market potentially. There's been stages where they have outperformed it. The main idea, from my understanding of what I've seen and people I've talked to and heard, is that these international stocks are trying to help hedge your bets against the U.S. stock market. The idea is that if the U.S. stock market's down, maybe the international stocks are doing better or not down as much. And it's things the idea is there where, yeah, you're hedging your bets against, you're diversifying. But even, let's just look at VXUS. It's the Vanguard Total International Stock Market Fund. And this is a stock market fund that's heavily recommended across the board. And if we just look into the since inception return of January 2011, it's really not gone anywhere. So as of right now, the price is, as of 2 days ago, was the price that it started at 11 years ago. So not a lot of these international funds really are not performing well. And so the idea is, yeah, you are hedging your bets against potentially both US stocks being down and international being up. That'd be nice. But that only really matters if you are in a position to sell your stocks. I'm not personally not interested in investing in these international funds right now when I have such a long-term time horizon, because I don't want to really, I'm not in a position to hedge my bets. I'm looking into creating value for myself in a long-term time horizon. So I don't care if the U.S. stock market is doing poorly, because I know that there will be periods of downturns, recession. That is inevitable. But those are opportunities for me to invest and lower my overall cost balance and take it as an advantage or an opportunity to invest. So I'm personally I'm not bullish on international funds and stocks. So if you do your homework, and maybe your brokerage has a good one, but even look at this. So the 5-year return on this Morgan Stanley Institutional International Advantage Fund is 1.6%, 7.8% over the 10-year, 1% expense ratio, which remember I talked about. 1% expense ratio is going to hurt. Not only that, it's down 41% year to date. And we look at these other international funds as well. They are down significantly. So this global equity income, if you invested 5 years ago, you would have been down year to date, down 12.7%. And it's all things to keep in mind. They're not going to be created equally. Then real estate. Sometimes you might get access to a real estate fund. Think about it. Real estate's cyclical, and this one has a high expense ratio. It's not beating the stock market, so it's not really something I'm interested in. Maybe investing in REITs, real estate investment trusts, in your personal brokerage account with something like which is Oracle Income Group, Oracle Realty Income Group, I believe. There are pretty good REITs out there, but you really have to do your homework. They're not all created the same. So I'm not even really, I'd never really considered the real estate fund for myself in a 401k. Now we are getting into the equity funds. So these are going to be your small cap, mid cap, and large cap. And as we can see here, so the Vanguard S&P 500, which is a very popular one. Look at this, 11.6% 10-year return, 9.2% 5-year return, 15.5% year-to-date. We are in a downturn. We are in a sell-off, so that is to be expected. And look at that expense ratio, 0.04%. This checks all of my boxes because it's outperforming all of the target date funds. It's down less than some of the target date funds that have bonds, and it's outperforming the aggressive and like every single one of the risk level and funds that were provided through my 401k. So I really think that when you're investing in your 401k or even any type of investment strategy, you want to incorporate some sort of core holding to really hold your portfolio together. And I really think that using a Vanguard 500 S&P 500 index fund or a total market fund, if you have access to it, a total market fund is essentially this S&P 500 complemented with small and mid caps as well, because S&P 500 is going to be the U.S., basically like the 500 largest, best, not necessarily best performing, but largest by market cap companies. So that's what I talked about. It's going to be your big name companies, and it's a composition of 500 companies across different sectors and industries to help have built-in diversification. So you're betting on basically the U.S. stock market as a whole. So that is a pretty safe long-term investment idea. And so I've decided to use S&P 500 as my main core holding, and I believe I have 50% allocated to it. And then now let's go to the small caps. So small and mid caps, as I talked about, these are going to be smaller companies, usually considered a little bit more risky. So let's look at the small cap growth. It's down 40% year to date with an average return of 10.5% over the past 10 years with a high expense ratio. And then looking at the value companies, this is where Vanguard is nice due to its low expense ratios. And here's talking a little bit about small and mid cap. This is why I think you should include small and mid cap in your portfolio. So this is using portfoliovisualizer.com. So we have an initial amount of $100, and we are starting in, I believe, 1972. So this is back testing historically. So starting with $100, and you are investing $100 a month consistently from then until now. And the funds, the asset types that we will be comparing is the performance of U.S. large cap, mid cap, and small cap. So $100 a month investment through the life of this portfolio, reinvested dividends. And as we can see, so large is in blue, mid cap is in red, and small cap is in yellow. Historically, yeah, there are going to be periods where I'm going to adjust it for inflation, and you can use logarithmic scale. But so there's a period where small cap was outperforming, then large cap kind of outperformed briefly, and then large cap went back to the bottom. Now mid cap has been outperforming. And remember, this view will change depending on the amount you're investing and how much your lump sum, whatever your strategy. But this kind of get a general big picture of historically small and mid cap have outperformed these large cap companies. So like in the large cap, I'm referring to mainly like the S&P 500. And so usually these small mid caps are going to be more aggressive during sell-offs. So like even right here, let's look at the housing market crash. The mid cap took a really big beating, and the large cap did as well. So I mean, just look at max drawdown. Yeah, these percentages don't look all that different. But even just look at the best year. Best year that small cap had was 55% return in 1 year. Mid cap was 49%, and large cap 37%. And then average return since 1972. Large cap 10.12%, which remember what I said about 9.5%, 10.5%. Mid cap 11.5%, and small cap 11.2%. So, and then this kind of did change though. For the past 10 years, we have seen a very large tech driven bull market. And so that is why large cap has been outperforming the past few years. But long term, um, there's potential for small mid cap to have their time to shine, because usually small mid cap companies are going to have lower premiums. What I mean by that is small mid caps are going to have lower price to earnings ratios on average compared to their larger counterparts in the S&P 500. Price to earnings ratio is a equity ratio that compares the actual revenue that a company is bringing in compared to its stock price. Higher price to earnings ratio means you're paying more of a premium for that company, and they are considered more overvalued when it comes to their stock market. You're paying more for their stock price than what the company's actually bringing in. I could do a completely whole video on it, but it's good to know what that is, and just you can do some research on that on your own if you're interested. Okay. So now we have gone into portfolio backtesters showing that these small and mid cap companies have outperformed large cap over the time horizon that I've chosen. All right. So now so we're going to have growth, value, and then a blend fund. Usually that are going to be your three options. You may only have the option for one or the other, but personally, when I'm looking at a long-term time horizon, I'm not as interested in these growth funds because they're going to be more, usually you're going to swing a bit more. So like 40%. The blend has down minus 21%, and the value is minus 13.5%. Then usually the growth is going to have a higher expense ratio. Depends, obviously, but so looking into that, we can compare the small cap and the blended fund and small cap value, and we can see over the 10-year, the return is really not a whole lot different. The value has a little bit higher expense ratio, but it's been doing better year to date. And that's as of right now. Value stocks and as a whole have really been holding their weight compared to growth stocks. I personally set it up originally as a small cap index. I may at some point switch to small cap value, but I'm not 100% certain if I will or not, because I have a long-term time horizon. And as I said, these sell-offs aren't really affecting me mentally because I know I have a long-term time horizon, and this is something I'm willing to invest in the long term. So when you're investing only in a value fund, you're excluding the growth companies. And when you're investing in a growth fund, you're excluding the value companies. And so that's why I kind of like these blended funds, because you're getting some of the advantage of growth and value, regardless of if we're in a time period where growth stocks are outperforming or value stocks are under or overperforming. So you get that blended. And that's essentially what the S&P 500 is. It's a blend of growth and value companies, and that's why the S&P 500 has historically been a great long-term play. Going into the mid caps, basically the exact same reasoning. The mid cap growth had a high expense ratio, not show-stopping returns, and a high sell-off. Looking at the mid cap value and mid cap, I once again went with the blend. It's got very slightly better performance, lower expense ratio, and I have a long-term time horizon, so I'm willing to take on some of the growth associated risks with it. Okay. So we've got through small cap and mid cap, and then going into large cap, usually you're going to have three to four options. You're going to have a growth fund, which for the exact same reasons I excluded the other ones, I excluded the growth fund because growth funds are basically high risk, high reward. They can go up a lot and then go down a lot. And when you're investing in these S&P 500 or more diversified, well-established funds, in the long run, these typically will outperform a growth fund. And you can do your own homework on that and do some comparisons, but for the purposes of this video, and my portfolio, I'm not a fan of including these growth stocks. Okay, now, so we talked about the core holding being the S&P 500. So we're going to have growth. We're going to have some sort of blended fund, which is S&P 500 for large cap. And usually you will have some sort of value or dividend fund. And so my value fund is the Vanguard Equity Income Fund, and that is ticker VEIRX. And you can always pull up, what's nice about Vanguard is you can just search up the ticker, and usually Vanguard will pop up, and you can really get an idea of this fund is meant to provide investors with an above average level of income, offering exposure to the stock market and usually potentially less volatile. So, for example, the 1 year return, the year-to-date return for VEIRX, which is the equity dividend fund, is minus 12%. Growth stocks on average are down 30 to 40%, and the overall S&P 500 is down like 21% as of right now, October 29th. So I think it's good to include some sort of dividend paying fund early on, because as you have these long-term time horizons, these dividend funds are going to compound over time, and you're going to get paid out more and more dividends in the long run. So when you are ready to switch to a more conservative investment style, as you're getting older, getting closer to retirement or at retirement age, you will have this dividend fund that's been growing for however many years you had. And let me even look at this dividend fund. It's not shabby. It's growing at 10.36% return over 10 years. It's got a little bit higher expense ratios than some of the other Vanguard funds, but it's still lower than the other ones, and a minus 4.58% return in the past year. So on paper, this has been what I'd consider one of the best options I have, and that's why I included it in my final four. And then talking about bonds, what I mentioned earlier is I'm not as interested in bonds because I have such a long time horizon. It's not worth, like, look at this, a 10-year return of 0.01%, 1.73%, 1.34, 0.061. These returns are worse than if I just put the money in my savings account. So if I'm investing long term and I see returns like that, that's not appealing to me. So I've narrowed it down to some sort of small cap, because those outperform historically, some sort of mid cap, which also outperforms S&P 500. We want a core holding, which I chose an S&P 500 fund, and it's good to have some sort of dividend fund, which over time you can start compounding that, and as you're getting closer to retirement, it's been compounding for years. And this is the personal allocations that I set for myself. So this is a 15% small cap, 15% mid cap, 50% S&P 500 as my core holding, and 20% towards the Vanguard equity fund. And talking about this is basically the exact same scenario, except for this comparison purposes, we did an initial dump of $10,000 because I wanted to do something different compared to the last one. So this is basically comparing the asset types. So we have the mid cap in red, small cap in yellow, S&P 500 in green, and dividend fund in blue. And this is a different time frame. It's from December 31st, 2001. So basically 2002 to 2022. As we can see, the small mid cap has outperformed. The the dividend fund was actually outperforming the S&P 500 for a while, and now they crossed during the COVID, and now that the income fund is back on top. So you may be looking at this and going, all right, so if that's all great, why is the S&P 500 my highest allocation? And yeah, I think that's a good case, but the reason why I'm including the S&P 500 overall is I'm basically betting on the U.S. economy as a whole to hold my portfolio together. That is the market. When people are trying to beat the market, they are trying to beat the S&P 500, and most people fail because there's going to be years where small cap and mid cap outperform, and there's going to be years where the S&P 500 outperforms. So I think it's good to kind of include. So with my particular portfolio, so I'm at 30% small mid cap, and then that's considered my riskier targets, 50% my core holding, and then 20% my dividend, more stable fund. And because as you can see, even during the sell-off, it's the blue stock, the Vanguard equity income fund, is really holding its ground, and I think that kind of showcases and justifies why I'm including it, and it's still getting a good solid return. So I know that was a lot of information. This was a long video, but when it comes into investing in your future, it pays to do the homework. And I think my goal of this video was to hit basically your fund options, how I find them, what kind of homework I do using Morningstar, TD Ameritrade, and the portfolio backtester to see how they actually perform relative to each other. It's good to know your expense ratio, your time horizon, because you don't want a lot of bonds when you're younger because that's hurting your overall portfolio. look into what you're actually buying. If your portfolio fund option says growth or aggressive and it's not even beating the overall market over 10 years and it has a high expense ratio, that's not very appealing. There's a lot of homework to do when it comes into investing, and I hope everything I said made sense. And most importantly, these funds that I have are going to be different from your fund options for your particular employer. However, the principle is usually going to be the same. You're going to have some sort of similar asset types to invest in. So always do your homework. Make sure that you're not just buying something because that's what your employer or advisor recommended to you. Always do your homework. Know what you're buying, know what your goals are, and know your time frame horizon. As you are younger, when you're younger, you have more room to invest in these stock market funds that are more stock oriented. But I'm still not recommending going all in on growth because it's really, there's periods, historically, value has actually outperformed growth in long time horizons. So know what you're investing in. And then as you're getting closer to retirement, you can start then that might be the time to start looking into bonds or dividend funds. But things to keep in mind. Hope this was helpful. I will be providing links to all this information in the description that I mentioned. Hope you enjoyed. I know it was a long one. I'm not sure how many of y'all stayed through this. I'm surprised I talked for 40 minutes, but that's how these videos tend to go, is I pick a topic that I believe is important to talk about or something useful. I turn my camera and microphone on and I just start talking. I have no script. I literally just pull up these tabs on my computer. I turn on the video and I start talking. So hope this made sense. Thank you guys for watching. Feel free to leave a comment below if you have any suggestions or recommendations of things for me to look into. Comment for content improvement or personal feedback. I am open to feedback. And if you enjoyed this video, feel free to leave a like, comment, and subscribe. It really helps the channel grow. Thank you for watching. Have a good one. Peace out.